All right, so I'm seeing some advice floating around to sell AMC and to buy oil stocks. Not only do I think that is terrible advice for our play, but terrible advice for investing in general. And we're going to talk about that in this video. How you can take profits instead of chasing profits. First things first, though, it was brought to my attention that apparently I don't know anything about investing or wealth because I wear this $5 plastic watch. I'm not going to say names. Somebody made a hate video about me. I'm not going to say names because I'm not, believe it or not, like I'm not into drama, guys. I don't want to start drama. But I thought this video was really funny because I mean, it's just absolutely ridiculous. For one, this $5 plastic watch is actually a $550 running watch. It's a Garmin Forerunner 745, so you can Google it and look it up. With taxes, I think it was $529. With taxes, it was like $550. And the reason why I wear it all the time, not just when I'm running, if you've been around the channel, you know I'm a hardcore runner. I wear it all the time because it tracks all my daily stats, which is important to me for training for my ultra marathon, my heart rate, my pulse ox, stress levels, all those types of things. So this dude said that I don't know anything about investing because I wear this $5 shitty plastic watch. So let's just take it off and download some investing knowledge from the Matrix. See, like you can see right there. So that flashing, that's the heart rate monitor and the pulse ox monitor. And I'm not really a watch guy, but I have a couple nice watches. This one's one of them. It's nothing crazy. It's not a Rolex. It's a Movado, which I really like. It's just a nice clean design and looks really sharp. So now that I've put on this nice watch, that means I've downloaded from the Matrix. Hold on. Okay, now I know everything about investing in wealth because I have this nice watch on. Oh my god, what a joke, honestly. But anyways, so let's get right into it. Not only, like I said in the start, not only do I think selling AMC to buy oil stocks right now is bad advice for this play, it's bad advice just in general for investing because a lot of investors make this mistake. They are in a losing position. They sell that losing position because they see a shiny object, right? Something running up, which is happening right now with oil, penny oil stocks, all kinds of oil stocks. And I'm also going to explain to you how you can avoid chasing something like what's happening with oil right now by having a proper portfolio. So anyways, people sell their losing stocks because they chase the shiny object. Well, what happens is you buy that stock that's been running, and then it loses its steam a little bit because here's some word of advice, guys. Just be careful. I'm not saying anybody's pump and dumping, but if somebody's recommending a specific stock or security to you, there is a chance, I'm not saying anybody is, but there is a chance that they are possibly pump and dumping it on you. So they're pumping it up because they already own it, which, by the way, who would go on a public platform with tens of thousands of subscribers and views and recommend a stock to you without already owning it first? Little suspect, isn't it? I will never recommend individual specific stocks to you because one, I don't want to get in trouble. I'm not a financial planner. But two, I just think it's risky. I don't want to be responsible for you possibly losing money. I do my own stock picking, and I'm going to keep that to myself. So recommending those stocks to you, plus I don't want to be accused of being a pump and dumper because, again, it just doesn't make sense. Why would anybody recommend a stock to you without already owning it first? Because if everybody's going to rush into it, they would already want to be there, wouldn't they? But anyway, so what a lot of investors do, like I said, is they buy sell their losing position. They buy the next shiny object that's running. And then what happens is because that was a pump, is that one starts to dwindle. So you've bought at the top now, you FOMO'd into it, and all of a sudden you look around and you're like, oh crap, that one that I sold, well now that one's running. So then you sell that losing position and then you go back into the one that you sold, which is now running. It's a terrible investing strategy. It's chasing profits and it's chasing trades and it's chasing trends that doesn't work long term. It might work short term, and you might get a little bit of profit in the short term, but it's a complete fluke if that happens because long term, you have to think like 10, 15, 20 years. You've got to look a far horizon out. It's kind of like a gambler's mentality, right? Most gamblers, what do? They tell you that they went to the casino and they won $1,000 or whatever they won. The thing that they don't tell you is they never tell you about the losses, right? Everybody always tells you about their wins, but they never tell you about the losses. And most people aren't tracking all of their trades. So it's called in behavioral economics, behavioral accounting. It's called mental accounting, mental math. So people and the human brain is very good at only tracking the wins and forgetting the losses. So in their minds, they're like, yeah, I made $1,000 on this, I made $1,000 on this, but they forget about the $2,000 they lost over here. Excuse me, the $2,000 they lost over there. So they actually lost $2,000 instead of making $2,000. Excuse me. So just bad overall advice, I think, to sell, especially AMC, especially in this play. Like, why would you advise anybody right now? We're into this thing. We're so far and deep into this. We've been holding so long. Like, I can't tell you what to do. If you feel like you need to sell it, go right ahead. For me, Like I'm at that point where I've been holding it so long, and I got into it initially as a fundamental play, thinking that the squeeze play was very skeptical and not likely. And then the more I got into it, the more I learned about all the corruption, manipulation, the naked shorting, the ladder attacks, the synthetics, everything, I realized, you know what, hey, there's a very real possibility that this thing could actually squeeze. It's not guaranteed, but it could. And I am refusing to sell my position until I either literally, you know what they say in sales, right? Until the buyer buys or dies. Like, that's the point I'm at now with AMC, is I will hold it until the hedgies buy or somebody buys it. Or it goes to zero. I don't care. I'm waiting this thing out. I am seeing it through to the very end. So why I also think it's bad investing advice in general is because with a proper investment strategy. Now, again, I'm not a financial planner, but if you were ever to deal with a financial planner but when you meet with them and you sit down and you get everything going, they will create what's called an investment policy statement, an IPS. And basically, the investment policy statement it's like the Bible of how they are going to operate managing your funds for you. So it's going to go over things like your risk tolerance, your investment horizon, how you're going to rebalance and how frequent you're going to rebalance the portfolio, what type of asset allocation, all these types of things. So whether you're using an investment advisor or not, you should have an investment policy statement, even for yourself. If you're doing this yourself, if you're a DIY retail investor, you should have your own investment policy statement. Something that just it keeps you, it's like a beacon of light. So the analogy is the lighthouse, right? It's the lighthouse, the beacon of light in the fog and in the storm. The investment policy statement keeps you on course no matter what's going on in the market. If there's wars going on, if there's depression, recession, there's inflation, deflation, stagnation, whatever is going on, this investment policy statement keeps you on course because it's your strategy, right? And with any good investment strategy, you want to have, it's called asset allocation, or portfolio allocation. You want your portfolio to be structured in a way that you have certain chunks or percentages to not only different types of investments, typically like paper investments you basically have fixed income, bonds, or you have equities, stocks. So the very, very, very first thing you do is you decide, okay, how much of an allocation am I going to have to stocks and to bonds? Now, some people it's called the age rule. It's a very, 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 very rough rule. In full disclosure, I don't use it. I'm almost 40 years old, so basically the age rule says that I should have my portfolio, again, it's a very rough rule, but it says that I should have my portfolio in 40% bonds. Well, to me, I have a high risk tolerance, so to me, having 40% of my portfolio in bonds at this stage of my life, it just doesn't make sense, even though retirement is kind of technically around the corner, right? It's not that far away, actually. But I think 40% allocation to bonds is crazy. Well, for some people, it might make sense. If you have a very low risk tolerance, then maybe you do want more of your portfolio in bonds. So anyways, once you have that figured out, so you have X percentage to stocks, X percentage to bonds, now it's a matter of slicing up that pie. So the stock pie and then the bond pie, right? In the bond pie, you might have, because interest rates are so low right now, you might have more short-term, like corporate bonds, for example, because you don't want to be holding long-term, 15, 20-year treasury bonds, because you're pretty much losing money. With inflation and taxes, you're basically losing money, right? So anyways, that's a whole different part of that, is the bond portfolio. But in the stock portfolio, the stock portion, again, you might slice it up with, a certain weighting to U.S. equities, a certain weighting to emerging markets, a certain weighting to European, or to whatever, different countries, right? And there's countries that you can weight your portfolio to. There is sectors and industries. There's like small cap, mid cap, like there's just so many ways to slice up the pie. And basically, ultimately, what I'm getting at is how you avoid, right now, how you avoid chasing these oil stock gains is, again, I'm not perfect. I don't know everything, even though I have the nice watch now and I've downloaded the Matrix. I don't know everything. But in my portfolio, I've always, I take little pieces from different people, right? Someone that I highly, highly respect is Mr. Ray Dalio. He was the fund manager at Bridgewater, and he's a phenomenal, phenomenal human being. The amount of information he's giving out for free right now is absolutely ridiculous. He's basically just giving back because he's no longer fund manager at Bridgewater. But anyways, he designed this portfolio. It's called the all-weather portfolio. So I don't follow it to a T because, again, this portfolio has way too much of a weighting to bonds, and I have more of a high risk tolerance. So anyways, I don't follow that because I think in his portfolio it's about 30% to bonds. But basically, the purpose of the all-weather portfolio, the thesis behind it is that you are prepared for all weather, right? Because there's essentially, he sums it up, there's essentially four different kind of economic seasons. There's inflation, deflation, there's economic growth, and economic decline. And the way the all-weather portfolio is designed is that you have it in a way that everything is uncorrelated to each other. So like bonds, for example. Bonds historically are uncorrelated to stocks. So when bonds go up, stocks are sometimes going down. And when stocks are going up, bonds are going down. So if you have not an equal, but if you have a certain percentage of stocks, certain percentage of bonds in your portfolio, it's going to be nice and balanced. So when your stocks are going up, your bonds are going down. But when your bonds are going up, your stocks are going down. So you're not losing everything, right? But basically what I'm getting at is the big key takeaway I took from Ray Dalio's all-weather season portfolio is the allocation to commodities. And he suggests 15% of your total portfolio should be to commodities. And then he also suggests it's kind of breaking it in half. So 7.5% to gold, 7.5% to oil. Now, I love my commodities. So here's how I've avoided, everybody chasing these oil profits right now is I've had a position and exposure to oil for a long time now. And in fact, I started buying a lot of it because I'm kind of a contrarian, right? I like to buy when people are selling and I like to sell when people are buying. And here's another point I'm going to get to is portfolio rebalancing is basically it forces you to do that. It forces you to sell and take profits and then buy the ones that are low to rebalance, which I'll get to. So anyways, commodities, like go back to, it was, I believe, April 2020 when they, like if you're a stock observer like me, wow, this was a crazy day. I'll never forget it because oil traded at negative $36 WTI, so West Texas Intermediate, traded at negative $36. Now, it wasn't an actual barrel oil that traded for negative $36. It was a future contract, but still, it really spooked the markets. People were like, holy shit, negative oil, like people are literally giving this stuff away. So for me, that was a trigger. It's like because everybody's panicking and selling oil, which the way my portfolio is designed, it basically made this automatic anyways, but I started buying oil because everybody was selling it and panicking. And the reason why I started buying it is because my allocation came out of whack, right? The thing I talked about earlier. So when you have a certain allocation of your portfolio to stocks or bonds or to commodities or to large caps or whatever you have it, eventually these things they're going to get out of whack a little bit, right? So that's where rebalancing your portfolio comes in. And you can do this, it's up to you, right? Some people, I think monthly is too much. Some people do it quarterly. Some people do it semi-annually, so twice a year. And some people do it yearly. It really depends on your style. Again, go back to your investment policy statement. I think a monthly is a little too much because that incurs a lot of trading fees, and trading fees are a big killer to investor profits. But anyways, quarterly is pretty good. So what ended up happening is in my portfolio, my 15% allocation to commodities, with a big chunk of it was actually 10% to oil and 5% to gold. What ended up happening is because oil was going down, it became a smaller and smaller and smaller and smaller chunk of my portfolio. It was sitting at around, I think at the time, like 6 or 5%. Meanwhile, some stocks were going up, right? So what I did when I rebalanced is I sold those stocks, I took my profits, and then I went back, which, again, because the stocks were going up now, they were getting out of balance. They were getting too high. So I took those profits, bought up the oil that everybody was selling, and brought that allocation back up to where it should have been, around 10%. And now it brings me to today where I'm sitting pretty. I had been building this position for years, like 2 years almost. Excuse me. And now oil is freaking going through the roof. So the same thing is going to happen, guys. And this is where it gets really cool, right? This is how you take profits instead of chase profits. Is oil, because it's been running so much, my oil positions are up like 400 or 500% right now in my portfolio. Now they're out of balance. They're too high. The allocation is more than 10%. I can't remember the actual number last time I checked, but it's definitely over 10% now. So what I'm going to have to do when I rebalance, when it's time to rebalance, because I do it on a very set day and quarter and all that kind of stuff, is I'm going to take profits off those oil positions and put them back into other positions that have come out of whack. Guys, it's that simple. Like, people make investing, like Warren Buffett says, right? Investing is, what does it say? It's easy, but it's not simple. Like, it's easy in theory, but it's very hard to execute. And everybody chases the shiny objects, right? And these classic, you know what? I'm just going to grab it right now. Like classic principles. Like I literally have this book right right by me because I'm reading it now for I think this is like the 6th time. Like this stuff here, like this is classic. Like Warren Buffett considered this book, The Intelligent Investor by Benjamin Graham. Benjamin Graham was like to Warren Buffett is like his idol. But anyways, he considers this book as like one of the Bibles of investing. But this classic stuff, just boring, simple investing. It doesn't get a lot of traction because it's boring and it doesn't get people excited. But that's what works. The exciting, exhilarating stuff. Like if a mentor of mine told me, if you want excitement in your investments, like go to a racetrack, bet on horses, go to a casino. Just get it out of your system. But when it comes to your portfolio, capital preservation is the most important thing. As Warren Buffett, I quote Warren Buffett a lot. As Warren Buffett says, rule number 1, don't lose money. Rule number 2, refer back to rule number 1, right? Capital preservation is the most important thing in investing because that chunk of money you have, that capital, that gives you the ability to invest and to earn dividends and interest and passive income through real estate, stock, whatever it is you're investing in. But if you lose that chunk of capital, you're out of powder. Your gun's empty, right? You have no bullets. You have no bullets left in your chamber. So, guys, it's classic stuff, really classic stuff. I know it's not sexy and I know it's not popular, but this stuff works. Like, investing is not supposed to, don't get me wrong, it can be exciting. And for that reason, there are a lot of fund managers and investment advisors that actually recommend that, hey, keep it separate from your main portfolio. So put it in a totally separate account. Keep it separate from your main portfolio, preferably in a tax-sheltered portfolio. Because if you do hit a banger, a 10-bagger, and you knock something out of the park, then you want to minimize those taxes as much as possible. But it shouldn't be like, in my case, sometimes it gets up to 5% of my portfolio, but I don't like it getting that high. I usually try to hang out at around 3% of my portfolio is allocated to just purely 100% speculative plays. Play money, basically. It's a play account. So if something happens, great. If I lose it, it's not gonna wipe me out. It's not gonna lose all my capital. I'm going to leave it with this. So another analogy I've always heard and respected, Warren Buffett again talks about this, is, investing is not about home runs. It's about hitting a lot of singles and doubles. Singles and doubles will turn into home runs over the long term, right? It's about staying on base, staying in the game. You don't want to strike out. I hope this helps, guys. I'm gonna lay back on all the drama shit because it's honest. As people have pointed out, it's not helpful. It's not helpful for this play or for anybody or anything really. So hopefully this was helpful, guys. I'll see you in the next video. Peace.